Do you suffer from the moral failing of being poor? Well, you're in luck because that is precisely the ailment we seek to rectify here at Cult of the Almighty Dollar. So if you are shareholder capitalism pilled and willing to do me a solid by watching this video till the end, that it may please the mighty algorithm, I will share with you the secrets of how we might transmute your small stock portfolio into one worthy of a red-blooded Ameriboo. Today we're going to talk about how we can make $100,000 by pressing the correct buttons in our brokerage. Does this sound too good to be true? I understand your skepticism, but it's my duty as some guy on YouTube to give you false hope and aggressively encourage financial flimflammery. To get to our goal of growing a stock portfolio to $100,000, we'll need a little help from our good friend, Manifestation.
I owe the banks a lot of money, but little do they know, I just learned about manifestation. Now I'm gonna get so much money, I don't need a job. I answer to no one. Everything is mine, thanks to manifestation.
But in order to fully realize what the universe has in store for us, we'll need to use an even more powerful, more dangerous tool. What I'm about to share with you will change your life. For the better. Well, it'll change your life. Let's just leave it at that. Options trading allows you to speculate about the direction of underlying stocks, giving you the ability to make money whether or not the underlying stock increases in value. This gives you an advantage over normie investors, for whom the only available strategy is buy low, sell high, because the truly evolved person knows that the best way to maximize tendies is by mastering the dark art of option trading. It's like Plato's allegory of the cave, which illustrates to us truth seekers the nature of knowledge and reality. It depicts prisoners chained in a cave, only able to see shadows dancing on the wall, mistaking them for reality, because they could not see the objects casting the shadows. One prisoner escapes, sees the real world, and returns to share his knowledge, but no one believes him. Option trading is sort of like that. All your life you've been told options are dangerous and bad. This is both true and false. And like most things in life, there's a bit of nuance here that's worth understanding. So rejoice as I, the legendary frog of investing, bring you the good tidings of option trading. But also beware, because this good news comes with a warning, my fellow dollar jockeys. I've said this many times before, but it's worth repeating. There are two ways to trade options, like a risk manager or like a gambler. In 2024, I did the former and managed to scrape up over 40% returns. Having absolutely crushed it, my hubris led me to enter my now infamous Google Leap in January of this year, a position on which I'm currently down like $3,000. In this case, it's self-evident that I traded like a gambler. Note the difference. In my haste to mirror the position of my investment advisor, I failed to do anything as far as hedging. I just dove right in and yeah. You see what that gets you. Anyway, buying leaps is more analogous to gambling, whereas holding shares, selling covered calls, and cash-secured puts is generally much safer. These theta gang strategies are what I refer to as trading like a risk manager because in the case of selling covered calls, you're basically hedging your downside risk by selling premium while holding shares of the underlying stock, which actually have a chance to recover in value, unlike a leap, which is at its core a depreciating financial time bomb that has the potential to be worth squat at expiration. If I had just bought 100 shares of Google while it was trading at $180 instead of going the leap route, I would only be down $600 right now. But no, instead I felt like it was a better idea to pay $6,100 to buy a $150 strike leap, saddling myself with a pretty hefty $211 break even.
Haha, you fool! You fell victim to one of the classic blunders!
This is why everyone told you to stay away from options when you were young. Because you can do things like this to yourself. Actually, you can do a hell of a lot worse than this, but that's a video for another day. As for me, I'm not that broken up about it. For now, I'm holding on to the leap, and if I can exit the position at a 20% loss in the next few months, it honestly wouldn't be the end of the world. So let this be a stark reminder to all those who would challenge the supremacy of Theta Gang. One of the reasons people find it attractive to buy calls rather than shares is because they don't have enough cash to buy 100 shares of the underlying stock. Because obviously only buying things you can afford is out of the question. Like, absolutely not. I'm an American, goddammit. I am over-leveraged to the max. My spending power is unbound and without limit. I am the perfect citizen consumer. I live and breathe to maximize shareholder value and promote the virtues of right hand. Praise our techno-feudalist overlords. What were we talking about? Oh yeah, growing our small account to $100,000. That is, after all, the magic number at which known weird guy Charlie Munger famously said that your gains begin to really compound, allowing you to reach escape velocity from abject poverty. Every American and Ameriboo's goal is to earn $100,000, and then turn that into $1 million by YOLOing into risky derivatives. Everyone knows that once you're sitting on 100 bananas, all your problems are magically solved and your life will be great. We can only hope. So in the coming months, I'll attempt to demonstrate the correct way to use options to grow a small account. That means the public account is finally live. Yes, you heard me right. You can follow the growth and progress of the public portfolio by joining the Cult of the Almighty Dollars Discord community, which is free. But if you sign up as a paid member either on Patreon or YouTube, you'll also get some additional insights like monthly performance and year-to-date details, which I'll be documenting in Google Sheets. This is my preferred method to track performance, and it's the way I do it with my main account. If you're a cultist or a high priest, I'll even consider your trade ideas, but no promises. Some of y'all are in the Discord talking about GameStop and biotech stonks. I'm trying to grow my account, guys, not end up behind the Wendy's dumpster. So definitely check that out if you're interested in watching me struggle to grow a $2,000 account using Fidelity, which I've also never used for option trading before. I know, I'm using a real brokerage instead of Robinhood. Ya boy's growing up. By the way, I know I talked a big game earlier about YOLOing and doing risky stuff with the public portfolio, but I'm going to be honest with you guys, I don't love losing money. I'm going to try to avoid that scenario if I can help it. Besides, it's not like I need anyone's help to lose money. So I'll be sticking with my tried and true strategies for the most part. I'll definitely do spreads and some risky stuff, but starting out, let's just keep it simple. At least until I learn how Fidelity works. And now let's talk about how we're going to make $100,000. But first, let me share one of my positions with you. I own 100 shares of Block, ticker symbol XYZ. I bought them late in February for $58 a share. XYZ is currently trading at $65 a share, and I've been selling covered calls against them for a while now, decreasing my cost basis. So as of June 7th, my basis is about $51.29. I normally don't sell options further out than 45 days, but I decided to sell a near the money December 2025 dated call option with a $60 strike price. This is really aggressive, but I reason that my portfolio might need some downside protection, and I'm willing to trade some capital appreciation for that downside protection, at least on this particular stock. What's cool about doing this is that I pretty much guaranteed myself a 19% ROI on my $5,800 position for 2025.
Take it to the bank.
Okay.
I guarantee it.
Because it's pretty unlikely that Block will sink and stay below $60 a share. Actually, if you want to be anal about it, you can annualize that return and see that it's closer to 22%. Not too shabby, right? For those of you younger than 25, a 20% return used to be considered excellent. Now you'd get laughed out of your AA meeting if you tried bragging about 20%. But 20% can do a lot for your portfolio. A 20% return on a $2,000 account means you've earned $400. That may not seem like much, but if you throw in some regular contributions, you might be able to start turning the crank on the old magic compound interest box a bit quicker than you'd have thought possible. I'm not going to say earning 20% plus is easy, reliable, or predictable, but I am going to heavily suggest it to keep engagement high on this video. Seriously though, don't get your hopes up, we're just having a little fun here. As an adherent of Theta Gang, I must say that I do enjoy the upfront cash premium I get to collect in exchange for the promise of giving away some shares of stock in the future. I was able to create these sorts of 20 to 25% guaranteed ROI situations quite a few times last year. 2024 was a good year, but this is 2025. And 2025 is a roller coaster made of termite-infested plywood and horse shit. If I annualize my year-to-date returns as of June 8th, it looks like I'm on track to earn about 35% this year. Assuming you-know-who manages to keep his mouth shut about you-know-what for the rest of the fucking year. Now 35% sounds impressive, but I'm not factoring in the $3,200 I'm currently down on my Google Leap. I've conveniently decided that I'm not going to count that in 2025, since, you know, it doesn't expire until 2026. You've got to play these psychological games with yourselves once in a while, guys. I don't know what else to tell you. Plus, if I told you what eating that loss in 2025 would do to my projected ROI, a few of my craftier subscribers could reverse engineer that number and figure out what my portfolio value is. It has not escaped my notice that a few of you are total nerds that do in fact have a grasp of arithmetic, so I have to be careful about what I divulge. I mean, obviously I love and trust you guys, it's just mainly for my own sense of self-worth. Some of you are really big ballin', and I don't need my subscribers feeling sorry for me. Like, You've all seen the bridesmaid clip enough times at this point.
Help me, I'm poor.
Anyway, let's say I'm confident that I can crank out 20%. You know what? 24%. Fuck it. I can already see the comments now. You can't do that. Please guys, just keep your pants on. This is YouTube, not Morgan fucking Stanley. We're allowed to let our hubris take the wheel once in a while. Let's at least for a moment ignore the fact that everything is on fire and pretend this is sustainable for the sake of getting me through this video. Obviously, growing a smaller $2,000 portfolio will be more difficult than a bigger one, but I think that part of the charm of the public portfolio is watching it grow and sharing that progress. Now, in order to hit our ROI target of 24%, we'll need to earn an average of about 2% per month. Now, let's say that I plan to contribute $300 to the portfolio each month. I'm not even sure I'll be doing that, by the way. I'll probably just add money randomly throughout the year, if I'm being honest. But for the sake of this model, let's just pretend we're going to be contributing $300 a month to the initial pot. That means in about 8 years, the portfolio would be worth $100,000. Easy, done, end of video, right? Now obviously this is an Excel sheet I whipped up on the fly and it contains some extremely rosy projections. We all know that in reality the path to 100k is going to be bumpy. There will be months where we absolutely crush it and crank out 7% or more, and some months where we either break even or decide to finally close some of our losers and eat some losses. The more we can reinvest our returns, the more fuel we're adding to the blast furnace that is compounding. For all you investing newbies out there, the concept of compounding is quite important. In fact, it may even be as important as manifestation, if not more. To illustrate, let's say we start off with a $2,000 portfolio and save $300 a month for 8 years without investing. If we do that, we'd end up with $30,800. Factoring in the runaway hyperinflation you can expect after the collapse of society in the next couple of years, that won't even be enough to get yourself an order of fries at Wendy's, even with your employee discount. But in my extremely rosy and unrealistic projection, which you should by no means depend on, society survives and you're able to keep on making decent returns. As you can see, by investing our money, we managed to produce about $65,000 more than if we had just saved it, making this strategy preferable to just stuffing money in your sock drawer. Here's a more believable example. If you can manage to generate just 0.5% monthly, or 6% annually, the compounding effect means that by year 8, you'd have $8,800 more than someone with a sock drawer portfolio. I know it's hard to get excited about $8,800 when you're young, but I feel obligated to share a mediocre/realistic and sad return once in a while. I mean, we can't just be all rah-rah, all degeneracy, Nvidia go burr all the time. Or maybe we can. Actually, the hell with it. Let's go back to our 2% per month returns. Again, I know I'm painting a very optimistic picture here. I don't know about you, but I'm here for it. We are in the moment. We are believing. We are manifesting. We are not entertaining negative thoughts. Thoughts about the fact that the world is literally on fire and we are as a species uniquely unfit to meet the many existential crises facing us. Let's not think about any of that. Let's instead think about the stonks market. So allow me to help you clear your mind as I guide you through a Cult of the Almighty Dollar approved meditation exercise. Close your eyes and take a deep breath. Now count backward from 10 as you continue listening to my voice. Empty your mind of all thoughts and imagine a green line. It begins to rise, slowly at first, and then exponentially as it begins rocketing into space, raining down tendies from on high. Now open your eyes and repeat after me. I put my faith in Jerome Powell, through whom all things are possible. Amen. Now that we've manifested a future of milk and honey for our portfolio, we face a new problem. What if the market does too well? Like, what if the S&P appreciates 40% compared to our paltry 24%? If that happens, my plan of essentially forcing growth by aggressively selling near the money calls means we'd miss out on a lot of capital appreciation, because we'd be forced to forego capital gains we would have collected if we hadn't been running theta gang strategies. For those of you who aren't initiated into the world of options, allow me to explain how selling covered calls works, and its potential downsides. I've explained covered calls in previous videos, but I think we're due for a primer. Because based on some of the comments I see on here and on Discord, some of you aren't that familiar with options. And that's okay. In fact, you're probably better off that way. Theta gang refers to theta decay in options. Theta gang are generally option sellers who try to profit off the time decay inherent in an expiring contract. There are generally two ways to use theta decay, or time decay, to make money in the stock market. You can either sell cash secured puts or covered calls. When you sell a cash secured put, you're agreeing to buy 100 shares of a stock at a certain price, the strike price, if the stock falls to or below that price by expiration. You get to choose the strike price and expiration date that you want, which is what makes options so fun. Let's say you choose a strike price of $20 expiring 30 days from now. Your brokerage sets aside $2,000 of collateral until the option expires, because you've committed to buying 100 shares at $20 a share in the event the stock price dips. For taking on this obligation, you get to collect yummy cash premium up front. The premium you collect is mostly a function of volatility and time till expiration. Let's say you were able to collect $50 for selling this put option. If the underlying stock price stays above $20, the option you sold expires worthless to the buyer, meaning your collateral is released and you've completed your obligation to buy 100 shares at the strike price. So in 30 days, you managed to crank out $50 using $2,000 as collateral. That's a return of 2.5%. If you can find opportunities like this every month, you'd basically be earning about 30% on your money. Now obviously if this didn't come with risk, we'd all be doing it and we'd all be bazillionaires. One of the risks here is being forced to buy 100 shares of the underlying stock, which is why you generally only sell puts on stocks you wouldn't mind being forced to buy. If the underlying stock from our last example dips from $20 to $15 a share, the person who bought your option will exercise it, forcing you to buy the shares at $20, which sucks for you because the current stock price is $15. But that's why the person on the other side of the trade, the option buyer, pays you a risk premium. They're essentially betting the stock goes down, and you're betting it goes up. If this happens, you're looking at a built-in unrealized loss of $500. However, you did manage to collect $50 in premium on the front end. So really you're only down $450 on the overall position. So try to avoid selling puts on crappy high volatility stocks. This is tempting if you're young and have no money. The premium you can collect may be attractive because option pricing factors in the volatility of the underlying stock. So instead of collecting a paltry $50, you may even be able to collect $100 from selling a put option against that same $2,000 of collateral. But the company against which you'd be selling that put may be a month or two away from bankruptcy. Options like this can be lucrative to sell, but you risk ending up bag holding a crappy stock that has the potential to lose 50% of its value overnight. And that's no fun. Anyway, selling puts on companies that aren't hot trash is generally pretty safe. Because if you get exercised, you wanted to own that stock anyway. And you got the shares at a lower price than you would have had you bought them on the date you sold the option. So you get assigned 100 shares of the underlying stock and go on your merry way. From here you can either just hold on to them and wait for the price to recover to a level where you'd be comfortable selling, or you can switch to selling covered calls against them to generate even more option premium. Selling puts, getting assigned the shares, then switching to selling covered calls is referred to as the wheel strategy. Entering a position using put options is step 1. Now let's talk about step 2, which is turning around and selling covered calls. Selling covered calls is conceptually easier to understand than selling puts, at least I think so. If you own 100 shares of stock, you gain the ability to sell an option against that tranche of shares. If your stock trades at $20 a share, you can sell a contract against those shares in which you promise to sell them if the stock price hits the strike price stipulated in the contract by a certain date. Let's say the strike price is $22 and the option expires in 30 days. Whoever buys this contract from you thinks the stock will appreciate above $22 by that date. So they pay you a cash premium now for the right, but not the obligation, to buy your 10 shares at $22 a share. The person who buys your call is more bullish on the stock than you are. Holding shares and selling covered calls is a moderately bullish strategy. All you're doing is hedging your downside a bit by collecting some option premium up front in exchange for foregoing any capital gains you might have gotten if the stock were to appreciate above the strike price.
I need cash now.
Similar to put options, the cash premium you collect from selling a call depends on many variables, including volatility and time till expiration. For this example, let's just say you got paid $50 for selling the contract. If the stock stays below $22 by the expiry date, you basically earned $50 for selling the contract, i.e. essentially doing fuck all. Anyway, the option expires worthless, your 100 shares of collateral are released, and your obligation to the buyer is complete, meaning you're now free to sell another covered call against those shares. Now let's say the underlying share price appreciates to $27. This is a mixed blessing. On the one hand, you still made money, but you could have made more if you hadn't bothered selling the call option and simply just held on to the shares. It's one of those situations where being a quote-unquote active trader can work against you. I discussed this in another video, which you should definitely check out. Anyway, here's what you'd make if the stock appreciates to $27. You collected $50 in premium when you sold the contract. After 30 days, the buyer of the contract exercises their option, forcing you to sell your shares at $22 a share. So if your per share cost was $20, that means you made $2 a share in capital gains, or $200. Add that to your $50 premium, and that means you made a total of $250. Assuming you bought the shares at the beginning of the month and sold them after 30 days, you basically earned 12.5% on your money. Not bad indeed. But had you just waited for the stock to appreciate, you could have potentially earned $700, a return of 35% over 30 days. The person who bought your option made out in the middle, basically getting the shares at $22, paying you a $50 premium for the privilege, and then turning around and selling them at $27 a share, netting a total of $450. So here's what I'm getting at. The theta gang strategy of selling covered calls by itself earned you $50. Not factoring in capital gains or dividends, the covered call premium earned you 2.5% on your collateral in just that month. Again, if you find opportunities like this on a regular basis, you can potentially earn an annualized 30%, which is pretty good until you get to the end of the year and realize that your dumbass still somehow underperformed the goddamned S&P. Motherfucker. Basically, theta gang strategies both hedge and come with risk. The risk being over-engineering your investing strategy when sitting on your ass and watching football may have earned you more than someone who does due diligence, reads Seeking Alpha, and makes investing their personality. Because as you've seen from the example, rather than making 12.5% over the course of 30 days, you might have been able to crank out 35% by doing less than fuck all. Selling options is like crack. You immediately get a hit of dopamine because you get cash now in exchange for promising to do something later. And once you start, it's kinda hard to stop. Fair warning. And now that we've manifested a world of line go up forever, you may want to think twice about selling covered calls, because what sort of loser wants to make 25% a year when they can potentially get a 50% ROI by simply holding an index and waiting for institutional investors to inevitably blast cocaine on the first sign of good news, once again sending the stonks market rocketing to all-time highs. In any case, if we actually manage to crank out the returns I've dreamt up on this spreadsheet, there's a somewhat believable chance that we can hit 100k by year 8, and honestly, we can't ask for much more than that. As long as you manage to avoid pregnancy scares, expensive vet bills, excessive spending on leisure activities, $100,000 in 8 years is within the realm of possibility. And we all know that after you hit $100,000, your life becomes easy and all your problems go away, which is why I think that's a good target to set for our public portfolio. Let's look at a slightly more realistic scenario. In this model, returns are a bit less optimal. It's a mixed bull/bear scenario. I figure I should show you what a less rosy economic outlook might look like. I threw in a couple of slower years and lost years in this projection, but it's honestly still very optimistic, landing us at $100,000 by the end of year 10. The average return over this 10-year time frame is about 15.6%. Just to give you a ballpark estimate of what this sort of return looks like on an annualized basis. 15.6% doesn't sound too unrealistic. Maybe we have a few more boom years followed by a couple of years of contraction before the line reasserts its dominance over the bears and goes up against all reason. The question is, can we expect the market gods to bless us with an average of 15.6% returns over the next 8 years? That, my friends, is the $100,000 question. To be honest, I think even my bull-bear model is pretty optimistic, especially since I think the US is going to be facing some GDP growth headwinds as a result of some of the half-baked policy decisions we're seeing come out of our dysfunctional-ass government. But none of that may mean a thing when it comes to the stonks market, which, as I've said many times, can remain irrationally frothy and disattached from reality and the laws of physics longer than you can remain a bear. All you can do is hope that you don't get caught with your pants down when the big one finally does come. This is where selling covered calls comes in handy. If the market sinks or stays flat, you're generating essentially free money in the form of option premium, which reduces your basis in those shares. Meaning, if your stock's price sinks a bit, you can still potentially make a profit on the overall position, even if you sell the shares at a price that's lower than what you paid for them. In finance jargon, you're shorting delta. This effectively hedges your portfolio against market downturns, while still allowing it some room to appreciate in value if things were to continue going well. By doing this, even if the market dips, you'd still make out better than someone who didn't sell covered calls. Here's an example of how the math works. Let's say a normie investor and an options gambler each have a $10,000 portfolio. They own 100 shares of Dickhole Corp at $100 a share. Our normie investor has hobbies and a life, so they ignore their portfolio. Our call options gambler, on the other hand, compulsively looks at technical indicators in a mad attempt to sell call options at the perfect strike price and expiration. Disgusting. Let's say they sell call options throughout the year and manage to collect $600 in premium. Their basis in their shares is now $9,400. Now let's say the stock price dips 5%. At the end of the year, our normie investor would have an unrealized loss of $500, whereas our options gambler would actually be up $100 on the overall position. So compared to our previous example in which the stock price went up and the options seller made out worse than team buy and hold, we see that a call options seller would make out better than a normie in the event of a market downturn. By selling calls, you're essentially betting that your stocks won't go up too much in value. Some men just want to watch the world burn and sell covered calls, am I right? One last thing. There's a ton of nuance to this, and it's one of those things you can only really learn by doing. So get out there and start gambling with options. It's so much fun. I hope I've given you something to think about and demonstrated the power of compounding returns to the uninitiated. If you're excited to see me attempt to speedrun a $100,000 portfolio, then you're gonna want to stay tuned to Cult of the Almighty Dollar. I'll see you in the next one, friends, and may J-Pow smile upon you and your family's portfolios from now until the end of time. Bye for now.
Control the oil, you control the world. Why was the Roman Empire so powerful? Olive oil. How did John D. Rockefeller become the richest man in the world? Crude oil. How did y'all boy Puff throw the greatest parties of all time? Baby oil.